I think we're off and running. Heidi ho, everyone, and thank you, Marlon. Welcome aboard, guys. It's telling me to unmute myself. I'm pretty sure you should be able to hear me, guys. There's a message telling me that's not the case. Weird and wonderful things happen in the world of technology that I do not understand. I don't have to, I guess. If it works, it works. But if you could tell me you're hearing me, somebody, that would be fantastic. And I can go on. And go on I shall. If that is indeed the case, I'm sure I would have heard by now if you can't hear me. Welcome once again to Trading Buddies, the second and final show of the week, of course. It is Thursday, the 11th of August, believe it or not. It is a fact. And I'm looking at the pound versus the US dollar, as we do each and every London Open. That would, I wish I did each and every Open, but I just don't have the chance often to get in front of the charts when it's not Trading Buddies time. What we're seeking to do here with the pound versus the US dollar at London Open is to trade a breakout of the range between London Open, between Asia Open, which is the Open of Tokyo, and London Open. So that range we need to identify. Tokyo Open is, I think, the fourth candle of the day. Third candle of the day, 1, 2, 3. That makes sense. So it's the 0200 candle. So that would be the top of the range. Well, at the moment, it's the top of the range. Looks like the pound may want to create a new top to that range. So anyway, looking at that bar as the top, we're looking at the bottom down here somewhere. So let's identify that. At the moment, we're there, and we're there. So the actual high is 128. Sorry, 28. Dream on. 122.21. 122.21. And the low is 121.82. So we get the difference between the two, 122.21, 121.82, which is 18 and 21, did I say? Let's make it 22, just to go to round figures. That would be 40 pips. Am I wrong? I'm right, right? Yes, we'll go with 40. So that means it's going to be a little bit longer now because this high is creating a new high. So we'll wait until that's the case. But at the moment, we would be looking at a mid-range, let's call it 24 now. So 82 to 24 is 42. 21 pips would be the halfway point. 21 on top of 82 is 03. So 22.03, that is the halfway point. And that's where we want to enter the market. Now, if we're above that median, if you like, we go short. And if we're below that median, we go long. That is at the time London opens. So today, it would be a short trade only because we are well above the center line. And I can prepare for that when I know what the exact high is going to be, because we need the exact middle of the range. So we're going to wait a few seconds before that candle changes. And when it does, we'll get the high of that candle, the low of the range, and then we can get the median point. I think at the moment we're pretty much spot on. 122, no, it's actually 122.25 now. The high of that bar or candle. And once we get there, I'll explain what happens next. Come on, little doggy, you can do it. Okay, so we use 25, which makes it another half on top of that. So it's going to be 122.025. And I've got that, so I can work that out. Righto. So let's place the order. Now, if you watching this for the first time, you won't recognize this as being an unproven strategy or system of trading, but that it is. We haven't proven this to be correct yet. G'day, Paul P. Happy Thursday to you too, mate. We haven't proven this to be trustworthy yet, so if you're putting this into the market, please, please, please respect that it doesn't have any kind of record as a winning formula. So do not risk any serious money on this, please, until we can prove it. Righto, so the entry is going to be 122.03. Sorry, 122.025. Get it exactly right. 122.025. They'll mess around with that anyway, by the spreads or by slippies, whatever. And the stop loss is going to be the high of the range plus the spreads. Spreads at the moment 1.3. Let's call it 2. So we're going to go with 122.27. 0.2227. That is going to be the stop loss. TP1 will be at 1-to-1. So we can put that in as a proportional target of 1. And we will do nothing in terms of taking money off the table at that point, but we will move our stop to entry. So the only thing you need to do there is put 1.0 if you're trading on the trade manager. But again, you know, very small risk. See, I've got 0.05 of a percent there. Nothing. And TP2 we will micromanage, but it's actually 2.5 to 1. Don't have to micromanage it, I suppose. We can go with 2.5 to 1. Just put that in, 2.5 to 1, and close the whole damn lot. 1.00, and that's all we need to do. So it's a sell order. And there we go. Put a trade through the daily pivot, which is acting as support at the moment. Not my favorite, but we're not here to do that. We're here to play by the current rules and see if that's going to be a winning strategy. Let's see. All right. So overnight, you can see that there was movement in the market, and that, of course, was due to the CPI figures coming out in the States. Market didn't like that too much in terms of the US dollar, and the pound rallied, as did others against the US dollar quite substantially. We've now got, of course, the CPI figures is all about the consumer prices or the retail price of goods and services. Tonight, we've got PPI, which was all about the wholesale price of goods and services. I believe the CPI is more relevant in terms of inflation than is the PPI, but both are completely relevant because the producers will pass on the price to the consumers. And that's what we'll be dealing with tonight. So if that number is a miss, and of course overnight the number was a big miss, sometimes you would call that negative, sometimes you would call that positive, because it depends on the circumstances under which we are faced in terms of what the inflation rate is at the current time. Is it rising? Is it falling? Do you want it to be a better number? Do you want it to be a worse number? So there's a little bit of toing and froing in that regard in terms of my mindset. And like we said on Monday, they were forecasting a better, inverted commas, number, and they got even, inverted commas, better than that, suggesting that, well, the Fed will take credit, as I said on Monday, suggesting that the inflation figure is getting under control. We'll learn more tonight again about that, as I said, with the consumers, with the producers' price index. Anyway, that's not my field of expertise by any stretch of the imagination, so I'll just leave that alone and go on to something completely different, which is currency pairs. Now, bloody Aussie Swissy. This wrecked us yesterday as well, where we were headed once again down to our first take profit, and of course the news came out and reversed that position quite substantially. And we're now somewhere between stop loss and entry. So in an unenviable position, but goodness gracious me, have a look at this chart. We've been in a similar position. I mean, we haven't been in the trade that long. We've been in the trade two and a half weeks, maybe nearly 3 weeks. But you can see absolutely nothing's happened. We've gone up, we've gone down, we've gone up. Hopefully we go back down again and get back in the money. But it's not a comfortable position to be in. I've got to say, I never like being in drawdown. But I don't see really there's anything I can do here except maybe play a little bit of a hedge. So I was considering that this morning. When I came up with a few ideas, we've got Aussie short versus the Swissy, which is really a risk-on currency versus a risk-off currency, or a risk-off currency versus a risk-on currency, whichever way you look at it. So I figured that there were some nice setups on similar paired currencies, and one of them was Kiwi yen. Now, Kiwi yen, if you suspect that's going to rally, and the chart's telling me that's entirely possible, so that becomes a buy for me. Now, if I'm selling Aussie versus the Swissy and buying Kiwi versus the yen, it's not a direct hedge by any stretch of the imagination. Well, by a little stretch of the imagination, but it is in part a hedge. So if that Aussie Swiss continues to rally, my anticipation would be that Kiwi yen will do something similar. And if that's the case, then this will produce somewhat of a hedge against the Aussie Swissy. We'll see. It may not be the case, but it looks reasonable to me to suggest that Kiwi yen can rally on the back of this potential false break. It's got itself back above all the pivots, as has Aussie Swissy. And as I say, I think this is a reasonable position to take. Don't like trading at these levels, I must say. But if I bring this back to the weekly pivot, we've also got a weekly game changer bar, and this was pertinent and always is if we're going in the same direction on a daily game changer bar as we are on the weekly. So it's very, very similar pattern. So I'm anticipating we'll get up to these highs, and I'll probably reduce or get out of most of that position if that is indeed the case. There were a whole bunch of stuff going on this morning in terms of game changer bars, as you might expect, given that we had major news out overnight. And lots of them, once again, were risk-on currencies versus risk-off currencies. And I think, as I said on Monday, maybe last Thursday, the market, to my mind, is on a seesaw or a teeter-totter, whatever you want to call it. One day's risk on, one day's risk off, next day's risk on, risk. It just keeps oscillating in a very, very weird and wonderful fashion. And that makes it pretty difficult to gather a hold of. But the two pairs that came up as both game changers on the weekly chart and the daily chart today were Aussie yen and Kiwi yen, both long. So I've traded Kiwi yen. I've left Aussie yen alone because that would be a direct hedge. Don't particularly want to take that path. Happy with the Kiwi. I think it's got better prospects, frankly. But there were two others that I wanted to have a look at today, and one was Euro yen. Euro yen not dissimilar in directional bias, but completely different in terms of the chart, because we saw a sell-off yesterday on euro versus the yen, suggesting that the yen is strong. I find that very, very hard to get my head around on a long-term or even medium-term basis. I think the yen has prospects because it's been sold off for so long, but I think that's the only prospect that it has. So, and then I think about the euro, and the euro, how has it got credibility even? So why would I want to buy it? It's kind of a race to the bottom for this pair in terms of relative strength. So I anticipate that one of two things will happen here. We'll go back to trend, which of course is very, very evident here. You've got a triple top, you've got a lower low, you've got a lower high, you've got a lower low, and you've got a potential another lower high here. Well, my take on that is well and good. If that is indeed the case, then price will continue to fall. If, however, we've got to get back to this level before we get another lower high, then an entry here makes sense to me with the stop loss underneath that bar. I haven't taken that position, but it was certainly on my watch list this morning because I see that blue sky until that level. There's a confluence running through there as well, around about that level. So I figure that 139.5 makes perfect sense to me, and you probably get a 1-to-1 trade out of that if you fancy the same. You may even get better if we come back to the weekly pivot and find maybe a false break on support and then trade it back up to there. I think that's quite a sensible position. If you aren't trading with green candles, which is not my thing, of course, but although I've done it on Kiwi yen, I like to have these red bars or red candles so that we can get what I call insurance. If price goes that way, it doesn't bother us. But my contention being, if it comes back to here, then I suspect it's going to here. That's Euro yen. The other one was pound Swissy. Now, pound Swissy could probably be considered a hedge similar to what I've just described on Kiwi yen. So a hedge against the Aussie Swissy, right, which is short, not direct, but anticipating that it's a possibility. So if I have a look at that, the one thing that entices me is not the bar that we got produced or that was produced yesterday, but this one here. And I'll show you for why. What I consider to be a range is, where's my little shape thing? Hello. Oh, the wrong thing, that's why. There we are. Let's go with a rectangle. And my idea of what a range is consists of two levels that are similar and on either side of that range. So I would have to pick two highs in here somewhere. I mean, that high is not going to match up with anything, but this one, maybe that one. But certainly across here, I can see some highs that match. And I want two on the bottom side as well. And they tend to match over here. So I can start that range over there, in my humble opinion. And what happens now is we've got potential for this to be a breakout and go on with the job, or to be a false breakout. Now, a one candle false breakout is a good thing to play. A 5 candle false breakout is a better thing to play. And what I mean by that, if this does break out and it's a decisive breakout, which this is, I wouldn't say it's a fantastic breakout because of the small size of the bar. But when you see that happen with a decisive candle, it makes perfect sense to me to put an entry above that candle and put a stop loss below it. That's been complicated by this hanging man doji sitting here, because there now is the new low. So it makes that stop loss a little bit vulnerable, let me put it that way. Interesting that we've got a little bit of a gap up, which has been obliterated so far today. I think that's still worthy of attention, that little bar sitting right there. On a smaller time frame, I'd be looking for that 5-bar play, as I said, to come back into here, come back and retest that level, then trade it. I mean, it'd be a lot more than 5 bars, but I think that's not the worst position that you could take today, given that, once again, if the pound does continue to weaken, which doesn't appear to be the case against the Swissy, you won't be in the trade and you won't be in trouble. So I think that's reasonable to watch. And that's about it, frankly. There were, I think, more game changer bars than not today out of the 29 pairs that we look at. I think there were 15, so around about that kind of average. But they were the ones that stood out to me, and that's kind of where I'm focused for the rest of the day. G'day, Ash.
Hello, buddy. How are
you
going?
Well? I'm good.
I am. Yeah, I am well. Yeah, it's very hot. Very, very hot.
Is it back to that 40-degree mark yet?
Close 37. I think we're talking about this week or next week.
Oh my goodness, the people in London
So
must be having heart attacks. I mean,
yeah, I
literally
mean
having
it is. We're a country that's not prepared really for one extreme or the other. But I mean, down by the beach is lovely, but there's talk of rock faces, cliff faces potentially collapsing because of the dry weather,
Wow.
and it is a concerning situation. There's no two ways about it, and scientists continues to say that any conversation about climate change that goes to government just gets fallen on deaf ears. So it doesn't seem like the authorities
Like every
really
government around the world.
yeah,
Yes.
they're not doing enough about it, and just like everything else, which will bring us to the market, really, it's all reactionary. And let's talk about the market because some fascinating things. I listened to what you were saying about the Kiwi yen earlier on. Yen, very interesting currency right now because of the potential strength in the yen, particularly against on the seasonal basis of the yen.
Okay.
And obviously,
I'm going to say
that
there has to be a reason, and I can't think of one. There's one seasonal, right?
well, do you know what? I mean, if we kind of line things up a little bit, you're absolutely right. There's little reason to buy the yen. However,
Apart
what
from
we've
the
got
fact
is
that it's oversold, of course.
yeah, well, exactly. I mean, we got an oversold position, so we can talk about technicals actually as well. But what we've got is a situation where the yen is the strongest currency seasonally. We got COT data suggesting that the buyers are coming back in, albeit from a slightly lower pace, but a lower rate. But the COT data is suggesting that there are buyers for the yen, and probably throughout August. So I suppose the messaging really from the seasonals and the COT is that the yen's unlikely to collapse. We're unlikely to kind of get some move down to the downside with the yen. Do we get some upside? It's possible, but what we really need is the fundamental driver. And it's difficult to find right now. We got CPI data coming out yesterday, a big miss. But what I find quite interesting is that it's still at 8.5%, and there's all this cheering kind of going on. So what market participants are effectively saying is the central bank will ease back on some of its policy. But then overnight, we had two central bank participants basically saying that's not going to happen. We're going to remain hawkish on the situation, and we are at these technical levels. So the recession concerns are still in play. We've got GDP tomorrow from the United Kingdom, and we'll have further data from the United States and everywhere else. Recession concerns are still in play. And that could be the yen driver. That's where we might see the yen go. And even though that catalyst isn't there yet, I think it's quite interesting to watch for longs in the yen rather than the short because of the COT data and what the seasonal's saying. We really need the fundamental to line up as well, and then those potential positions will come into play. Because just like everything else, I watched that CPI data come out and I saw the market rally, and then today I was thinking, you know what? It's a weird thing, the market. Good news is bad news sometimes, and bad neuse is good news. So even though we've got the print is positive for CPI, but have we basically been buying into that number, waiting for that particular number? That's all priced in, and now we start to take on and digest the next load of numbers. This is what we got with the FTSE, where the FTSE 100 is really right on top of. But look at these areas over here. Not so good on this. Here we go. Look, you've got a dip down here, a try and a fail there, another sort of like dip here.
Share your chart, mate.
What's that, buddy?
Do you want to share your chart? Oh, you have shared your chart. Sorry.
I have changed. Yeah. So we got.
Okay.
That's all right. We got quite a lot going on, really, because we do have this line in the sand, messy over here, but you can see it's starting to come into play here. Definitely here. Definitely here. Maybe a little bit too far away there. But the other thing is that it's a 7,500 handle, which is a round number. So this is an area that would suggest the FTSE could start to see some reversal. But again, we need to see, what's going to drive it down. CPI data coming a little bit weaker isn't likely to do that, but the PPIs might do. But there's a resistance level here. Now we go to the US market. The NASDAQ 100 broken through its level last night.
Yeah, I've got the same.
Just there. It's just above it now today. You know, it's just above the previous level of resistance, and it could go to the next one. I think the problem with the Nasdaq is that when you look along here, it looks like that resistance line might come into play before we start to pull back, maybe to the monthly pivot. So far, untested. Let me just clean this up a little bit.
I'd like to see that duck back underneath that cross. That'd be pretty cool. Cool.
Yeah, you'll be going short then, right?
Mm-hmm.
Yeah, I think you're right, mate. And I think that's, you know, again, you know, we'd be looking for the catalyst. Doesn't seem to be there right now. You know, the other one is the S&P. Now, the S&P is a slightly different picture because the S&P really, if we sort of like start to look along trend lines, it's got some room. You know, it looks like it's through this level now. There's the next potential level according to the daily chart. So there's another move on the S&P that could be another. Looks like another, potentially another, maybe 2% higher. So another couple of percent higher on the S&P, and that could drive the FTSE and everything else along with it. So market's bullish right now. The market's is definitely got reasons. Market participants, I should say, have found reasons to buy the move. The big question is: Are we basically in a bear market rally, or have we actually turned? Have we actually turned the corner? Well, the big picture is that we haven't turned the corner. The big picture is that inflation is still rampant, 8.5%. We've still got central banks that are looking to raise interest rates right the way up to 3.5% to 4% by the turn of the year. We've got GDP data, which so far has remained robust, but we do have this global slowdown. So I think there's still some downside to come in this market, but I wouldn't want to get in really just yet. So I'm waiting to see what's going to happen. Now, if that is going to happen this month, again, that puts us back onto the yen. You know, that would take the yen potentially back up again. What you were just saying about the pound as well, GDP data from the United Kingdom tomorrow as well. So that may move the pound one way or the other. Mm-hmm. Not you know, the most favored currency to trade right now. And I think you've illustrated the point that we are risk on, risk off in pretty much all of them. They're very difficult. The only one that you kind of look for is potentially the dollar. You know, the dollar really does get harmed by that weaker CPI data. We did start to see the yield come down yesterday. Gold also started to ease to the downside after the inflation data was a little bit weaker. And you'd think that gold would, you know, considering where we were. We seem to respect technical levels with gold, and there is potentially a level along here.
Yeah, you thought it might have crept through the most crucial level, but
I think it probably has. And this is some of the issue with some of this stuff, is that there's a lot of lines. You know, there's a lot of areas that we could focus on. There's not really one defined clean level that we are looking at right now. So gold does look like it's got through some levels, but it also looks like it's got some resistance points as well. And if you look at this on a week-on-week basis, you know, simply the horizontal level of a breakout is probably the easiest thing to look at. You know, this is where we bounced before, went through. We're basically back to that particular level there. So there's a chance as well that gold does ease to the downside here, but we'd have to bring in the dollar, and the dollar has seen a significant move lower. And you know, we're back on support on the dollar as well in actual fact, but it's seen a significant move lower since the where are we at? Really the start of July. The dollar's been selling off. Did gold do a break and retest on the 4 hour? Oh, yeah, actually, the 4 hour is going to be quite interesting. Yes, it did. Yes, it did. So maybe a lower high coming in with gold. And now you mention the 4 hour, it kind of brings me back to the yen. Look at these are the yen. Right on, you know, the yen, this is the dollar yen, down, testing the daily pivot near enough and coming down. Aussie yen. Actually, the Aussie yen looks okay, as does the Kiwi yen. But you look at the CAD yen, same thing, down, testing the daily pivot, coming down. Swiss yen.
CAD's surprising. You know, CAD's, well, I won't say intrinsically, but currently, let's say for the last 12 months, one of my favorite currencies because I think it's got strength behind it. Yet at the moment, nobody wants it. Nobody wants the CAD at all. And maybe that's to do with oil coming down.
I think it is the case, mate. But also, I think that some of the moves that have been predicted have been priced in. You know, same with the dollar. So the moves were priced in because of the interest rates, potential that happened, and that did come through. Now we've got weaker numbers, particularly from the United States. Now everybody's unwinding and thinking, hold on a minute, we priced too far, we priced too high. The reverse will probably happen at some point where they'll price too low, they'll overshoot it to a degree, and it's possible that we see that with many of these currencies where the pricing in is kind of gone in the opposite direction. And this is why the yen may well do okay, because even though there is no prospect of the Bank of Japan raising interest rates, if the others start to slow down, then the yen catches up by default in a way. You know, the expectation of the yen catches up by default. So that's why we might well see a rally now in the yen, and we might well see a rally in the euro dollar as well. You know, because of the sentiment shifting. But I think it's the same with the CAD. You know, there were expectations that the Canadian dollar would, the Bank of Canada would go and go and go. Now we've got inflation data, which could be suggesting a possible pause, as you've touched on. Oil has started to ease to the downside as well. So another reason that there could be a possible pause, or at least not the huge hikes that we were seeing as a prospect a few months ago. So the CAD might come back into alignment a little bit. And I suppose you want that because overall, yes, we should be bullish on the CAD, and yes, we should be bullish on the dollar against the likes of the yen and the euro. But we do still need better prices. We can't just go all out and out buy. Well, 100%, yeah. You know, so maybe what we need with a CAD is for it to ease a little bit further lower. You know, there's certain currencies that you wouldn't want to touch when it comes down to going long. The pound's one of them, the euro's probably the other, and the yen's the other. So you got a choice, really. You could, well, when I say going long, I do mean on the longer term horizon. Shorter term horizons, all those things are fine to play. But on the longer term horizon, you wouldn't really want to touch those, but we do need them to rally if we're going to go short with them. So so the CAD easing down a bit will probably does help us out. But you know, things could get trapped. That's the other thing that happens here, is that we've had such huge rallies in the first 3 to 4 to 5 months of the year. Are we now in the because the markets don't tend to rally, you know, they tend to be in ranges. Are we about to kind of hit that phase where currencies, that is, are we about to hit that phase where we just flip-flop around a little bit until the next thing comes along? Because most of the stuff that we've had is probably now priced in. You know, the Ukrainian conflict, there's been no escalation over the last month or so, so that's kind of priced in. The situation in China didn't really, or hasn't as yet turned into anything. The energy crisis could be easing, you know, and if you look at the CPI print, that's suggesting to be the case, particularly with the price of oil coming back a little bit. So there's a few things that are maybe pausing before they turn and resume their the underlying trend.
Yeah, I thought with the CPI that would be a far more relevant figure than tonight's figure, which is the PPI. But then I think about that more deeply. I think, well, really, it's got to go through the PPI first before it hits the CPI. Yeah, because it's all about what the wholesale price is, which dictates the retail price, right? So that will be, to my mind, a better gauge of what we're facing right at this moment will be the PPI figure. Because if that's slowing down, it probably means a whole lot of ingredients. But one of them would be that the supply chain is starting to improve. And the other would be, obviously, the demand for those goods and services is starting to be met by supply. And if that's the case, then things do look to improve. Just one figure on the CPI, to my mind, doesn't really mean a whole lot.
Agreed, and I suppose that's the point, is that you know, when that's digested and the market kind of like looks at it and thinks, well, we've got another month and a bit before the Fed come back again. Between now and the month and a bit, we've got lots of data coming. The PPI is one of them, but we got unemployment data. The unemployment data last Friday, we can't discard that. That was incredibly hot. So we got a very tight labor market. And okay, yes, CPI data has come down a little bit, but it does suggest that that the Fed have still got some room to maneuver. With the unemployment figures coming down so low. Can comment your views on the euro dollar. Will the not so good news on the dollar yesterday and upcoming news today affect the long-term, short-term trend? Is the upturn on the euro dollar going to reverse the short to become long-term? Okay, let's have a look at the euro dollar and be good to get your views on this, mate, because you trade the euro dollar quite regularly. So, well, okay. So the first thing about the euro is due a rally. There's no question about that. We saw it down and just like everything else. And this is the interesting thing about the FTSE. The FTSE is at a significant level of resistance, and it should resist. The euro got down to parity, and it should have been supported, and it has been. And now we've got. So people will kind of like put in, and this is almost the way that the markets work. People will almost put in a little pilot entry, and just say, go and be the canary in the coal mine. Go and see what the air is like, and see if we can actually kind of get any kind of rally going here. So we've got a great price. We've got a decent level of support, technically speaking. It's going to need something significant to drive it lower again, but not too much significance to drive it up again, because this is an extreme point. So we get down to parity. People start putting in orders in the euro. Then things start to actually help the euro out. The CPI data yesterday does help things out. We had numbers from China a few days ago as well. Also inflation data that was helping things out. We had trade balance from China helping things out. So all these things are really good for the euro. Now, the question of whether it would reverse its position from here would be something that you'd be putting your neck right on the block with. I don't think I would want to say that, but what the ECB's current interest rate is at 0.5. So their interest rate is at 0.5%. And if you look at the dollar, let me see what we got. I'm just going to bring up some of the other data points as well. Okay.
You want me to chip in my 2 cents worth whilst you're doing that?
Yes, mate. Yeah, go for that.
Yeah. Look, to my mind, the euro is, one of the weakest currencies on the board for good reason. And it's all, to do with the turmoil that's been going on for quite some time now. It's not so much that the euro deserves to rally. And I think you'll find against a bunch of currencies, it won't. Those currencies, to my mind, being the Aussie, the CAD, the Kiwi in particular. I think what you will find is that the US dollar versus the euro will be the one that you can probably bank on, inverted commas, reversing at some stage. Now, I base that not on what the euro's value is, but what the US dollar's value is. And the US dollar, to my mind, will at some stage be worth half the value that it currently is. Now, that's based on world events, really, and what's happening around the place. If you consider, and I've said this a few times, if you consider what Russia are doing at the moment, if you consider what India are proposing to do, if you consider what Saudi Arabia are talking about doing, and that is dismissing the US dollar as the reserve currency. Now, the instant that happens is all the US dollars finish up back in the US and become pretty much worthless. Well, they're going to be worth something, obviously, but they've printed so much of it that eventually, guess what happens when you've got so much of something? It becomes of less value and nobody wants it, right? So if all of those countries that I've just mentioned and they're not little players by any stretch. And I don't think I even mentioned China. Right? And China are on the same warpath, if you like, where they don't want to sell their goods and services in the reserve currency known as the US dollar. So, the instant that happens, and I don't know how that takes place, I don't know when it takes place, the US dollar is worth far, 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 far less than it currently is. And to my mind, that is probably not that far away. Now, if you take into consideration that that is in the background, the market will eventually start to price that in. And when that happens, you will see the euro dollar not at parity, but at $1.50 again, it to my mind. So I think the euro dollar long term is definitely a buy. Whether the euro Aussie is a buy, the euro CAD's a buy, the euro Kiwi is a buy is a completely different story, in my humble opinion. So if you're talking euro dollar only, then I think long term euro dollar is a buy. But today, I can't give you that same strength of argument, because I don't know when this is all going to take place. But when it does, that's when I want to be on board euro versus the dollar. So that's my take on it.
This is what I mean. What we've got really with the euro dollar is I'm just looking at the numbers. So the euro unemployment data is at 6.6%, and in the United States it's at 3.6%. But actually, if you look at what the euro tends to be, what the eurozone tends to be on relative terms, it's still quite low. Historically, if you look at the last 10 years, actually 6.6% rate isn't too bad for the eurozone. And obviously the 3.6% in the United States is amazing. It's an amazing rate. But they've both got inflation data, which is sort of like bubbling around 8.5% to 9%. So there's lots of things when you sort of like start to look at the data that suggest that the euro dollar is pretty close together. They're locked together. PMIs in both areas also quite close together. The eurozone isn't doing any worse, hugely worse than the United States. Now, the question really comes in about the value of the currency when we consider what the central bank's position is going to be. The ECB have taken it to 0.5. The Fed have taken the dollar to 2.5. So if the price today is pricing in that particular point, then now we are flat. So really the question from here is what goes next? Who goes next? Will they stay in lockstep from here on in? Will Europe go to 1%? They're unlikely to go to 1.25%, I would have thought. But the Fed probably, could still go to 3.25%. So they could have a 75 basis point rise, where the ECB will probably go a 50 basis point rise. So the Fed have still got the ability to accelerate faster. But when you start to see numbers like the CPI that we saw yesterday, there's a chance that they might just ease back, because what no central bank wants to do is choke the economy. So even though they're fighting inflation, they might start to say, you know what, it's coming down sufficiently. It's not so dangerous now. 8.5% is still bad, but it's not so dangerous. Maybe we can ease it down rather than really rush it down. And if we can do that, then we can start to ease the rates up slowly from this particular point. And the ECB, will potentially have to do the same sort of thing. So really the question we've got to ask ourselves is, from this point, will the ECB stay in lockstep? Will their policy be the same as the United States? Well, the big problem is Russia. So where the summer is easing the energy crisis, because the Eurozone don't need the energy in the same way that they would do in the winter. As soon as we do hit the winter, and Putin starts to squeeze again, which again, as I mentioned before, the news on the conflict in Ukraine has subsided somewhat. Much of the conflict has been priced in, and it's not really flaring up to a point where there are any shocks. But all Putin really needs to do is kind of like squeeze again, and the euro's coming back down. But while that's not happening, the euro does have a chance to rally. I suppose that's really sort of like the core of the answer. The euro does have a chance to rally. I don't think it's got a longer term, particularly positive position, the euro. And I completely agree with Jeff. I think the Aussie, the Kiwi, and the CAD much safer places to play against the euro. In many respects, because their economies are just a lot more robust. And the problem with the euro dollar, the US dollar, it does loom. And while we're seeing sort of problems in Taiwan, and of course, you know, the situation that's going on with Russia, the dollar is at risk. But I don't think that the euro can outstrip it ultimately. So then we sort of like have to bring in the technicals, and if we bring the technicals in,
even long term, so you don't think the reserve currency thing's going to happen, or you don't think it's going to make a difference?
I suppose I don't think it's going to make a difference, because I think if the dollar gets affected, well, I suppose, you know, if things do get bad with the dollar, it's going to depend on the catalyst. If the catalyst comes from Russia, I guess the euro is probably going to get affected as well. And my point on that would be, I probably wouldn't want to trade it against the euro. I'd probably be quite happy to trade it against the Aussie, CAD, Kiwi, or gold, but I'm not sure whether I want to pick the euro, because the euro zone is still geographically in a pretty tight spot, considering where they are, and also the economic situation in Europe is in a tight spot as well. So I don't think I would look for it against that, and I'd be quite happy to say let's say what's going to happen on the short term, but when it comes down to long term, because the factors that could change the euro, the dollar as a reserve currency would be unknown, and it'd be difficult to know who else is going to get dragged into that. I probably wouldn't play it, and I certainly wouldn't play it against the euro. But you know, again, on the short term, if we're sort of like considering this is the position we got. We got this channel to the downside, and some room to get to the top end of that channel, and that point is around about another 50 pips from where we are now. Not that much, really. Is there a setup? Yeah, it looks like there's a little bounce off. I mean, you must be liking this, mate. The little bounce off the daily pivot does suggest we get here. So on the short term, yeah, I do see a rally in the euro. We had CPI data yesterday. The market's still pretty hot on it. Didn't like the print at all. And it would suggest that the dollar's probably still got a little bit of downside, but only a little bit. I mean, you kind of bring this out on the dollar, and you can see that on the weekly, actually, you can see there's some support there that we're hitting. There's probably some a little bit lower as well. So this would go in lockstep with that move on the euro, which does suggest it's going to happen. And certainly from what we had yesterday, there's no reason to buy the dollar. So you know, if you are looking to go short on the dollar, yes, you could trade it against the euro. I'm not sure whether it's the best, but you could definitely trade it against the euro. And as I say, the data that's coming out from the Eurozone in comparison to the United States actually isn't that bad. You know, they're getting pretty close. So if there is a hint that the Fed will ease back on their monetary policy, then there could also be an expectation that all of a sudden we do get in lockstep. The ECB can raise 0.5% while the Fed go 0.5% if inflation data starts to come in weak. So the euro dollar looks okay. You know, but I don't think I'd want to go long term at this stage. I think that would be my take on it personally, mate. Happy to trade it long, but I'd be sort of quite cautious on the way that I approached it.
Yeah, same. And I'll show you my chart on euro dollar at the moment, and I see that at an inflection point, because we've come back to this support level, and that you would imagine will cause some resistance for euro dollar. And I'm looking at a daily chart at the moment, and my take would be that this is either going to be, I won't even call it a bear flag, but I'll call it a pause in the downtrend. I'll put it that way. And if I see a let's say a game changer bar to the downside, or a false break of this area, then it becomes a sell again. And I agree with you. You know, parity is such a strong level that you would be expecting this to rally its head off that level. Well, okay, not so rally. You would expect a bounce of some substance. So this is a crucial level, and if it can get back above this level, then we have to look at a strong resistance level, and that probably happens, you know, around about here somewhere, which is, you know, some 500 pips from where we are, 400 pips from where we are. So I think if you're patient enough and see what happens at this level, the market's going to tell you, because this is crucial, and so is that. And if you can get through this, then it becomes a buy to there. If it doesn't get through this, look out, the euro's gone again on the strength of it being a weak currency, and the dollar rallies again. And the dollar will rally again. I've got no doubt about that. If you look at the dollar index, which I just pressed the wrong button on, there it is there.
I guess this is the thing, isn't it, mate? Is that, you know, so Jen, you have to recognize that that everything's 50-50, really. It's just sort of like when you gather the information, what gives you that little edge, and really we are at right on top of the 50-50 level, not far away from the 50-50 level. You know, we kind of we could fade here and start to see a signal to short the euro dollar again, which over the longer term over the medium term basis is still the play. The euro is still weaker than the dollar, potentially, because that one CPI data coming off a little bit does not suggest the Fed are going to come back, and there's still problems in the eurozone. But in saying that, there might be enough priced in to the downside with the euro dollar that suggests that it was overcooked. So it could start to rally to the next point before they say that actually this is fair value. So we are at that 50-50 point, and it's really waiting, as you said, Jeff, it's really waiting for the correct signal, isn't it? Yeah,
and you're going to get it. I mean, it will be obvious, or it should be obvious, that this level breaks, then euro dollar's a buy, because this is an upside down version of it, right? This is the US dollar versus 6 major currencies, but I think it's heavily weighted in favor of the euro dollar. Sorry, in terms of the euro dollar versus the euro versus the dollar. So this point here, which is an upside down version, as I said, of this one, is exactly the same thing. So I think you're going to get a signal loud and clear that this wants to go to here, or it goes back to parity, one or the other. And it wouldn't surprise me at all to see this back at parity, put in a double bottom, then rally. You know, it's all about timing. And what causes it, we don't know at this point. But to me, it's pretty clear that we're at that inflection point, and we need to wait right now to see exactly where it's going to go. So to answer your question, Jen, got no bloody idea, mate. But long term, long term, I reckon it's a buy. Long term.
Do you know, the other thing about this is that there are simpler times to kind of like pick a market than others.
Yeah.
And I've got to be completely honest. If I'm looking at the FTSE for me is at a sell point. So interesting to look for the short side. But we don't have the catalyst, so difficult to kind of like pick it. But it does look like it should be a sell. S&P should be a sell. The Nasdaq should be a sell. But all of these sort of things that the sentiment is now sort of like flipped around a little bit. So while the dollar is eased back in the way that it has, my personal view is I prefer to look for longs in the dollar. I prefer to look for short in the euro dollar. Now, it may not be here. It may not be at this particular point. The current trend is down on the euro dollar. No matter which time frame you look at in regards to the big three, the monthly, daily, and weekly, the current trend is down. So, in fact, the daily, you could possibly argue yesterday's bar was a little bit taily, wasn't it? It wasn't the best bar really to suggest that we are. It's
interesting when news comes out to see exactly what happens, and I think we saw that with the employment number last week. All it did was go to a resistance level and
Yeah.
stop. Couldn't
Yeah.
get through it, right?
Yeah.
And this is exactly the same yesterday. Got to the resistance level, couldn't get through it, and we pulled back off that level. So yes, your tail is telling you a story, and that story is really relevant in my humble opinion, because if this gets above here and then comes back under, this is the story that's being told. Good news couldn't drive it, right? And therefore, if it comes back under there, we're back down here, in my humble opinion. This could well be a false break of that range. Don't know.
But then I suppose in saying that, if we do take that high out and it holds, then we got a rally on, because then we can sort of like, and that's where we are, isn't it? I mean, I suppose, it'd be a difficult trade. I think going back up to the top line on the short term, no problem at all. But actually, if we're looking at the dailies, what's going to happen on the daily, day over day time frame, week over week, month over month, then we do need a little bit more information. We've got to take the top of yesterday's bar out, as in close above it, and hold there. So as it comes back, it doesn't come back fast and it doesn't come back hard, doesn't close below the trend line again. It gets a few closes where possibly tests the underside of it, but closes above it. Then you've got something that you can actually get your teeth into. At this stage, we just don't really have that. Because as I say, that the trend is still down with the euro dollar, and there's little to suggest that the fundamentals have shifted. It's just that it's possible that the pricing of this asset has been overcooked, and they need to reprice it, and that's what might drive the euro dollar a little bit higher. But the overall picture is still pretty weak for the euro because of where it is geographically, and okay for the United States. Those unemployment numbers last week were stellar. They really were incredible. You got companies that continue to report and beat on profits and everything else. So the United States isn't too bad. That recession concern at this stage is not really coming through. That's the other thing we're looking for really with the dollar. We need some weak numbers, because those weak numbers may well push the Fed in. We need the CPI to come down and some of the growth numbers to also come down, and that would suggest that the Fed can pivot. But at this stage, they're not looking like they're going to do that. So we've got to be very, very careful to jump in too early, and we need information. And the chart, as you said, mate, should tell us that. Should tell us what the information is.
Here's the interesting thing about last week, and that's what I was saying. With that stellar number, as you just said, here's the candle from last week. Couldn't even drive it to resistance, much less through it.
Yeah.
And now we've had another number that I guess will be either backed up or dismissed by today's number or tonight's number. And that's when this is probably when we're going to find the directional trend for the next 2-3 weeks, month, or whatever the case may be. It'll depend a lot on what that number is. And if that number is similar to yesterday, then I think this is probably on this 107.5. But until that happens, I can't tell you. We're still at this point where I can't trade this until I get that signal. Okay, this is false or this is strong, one or the other. And then if we get up to here, it'll become completely obvious to me what has to happen next. We go back to here. Then we've got an inverted head and shoulders, and maybe we're on for that long-term thing, But
yeah,
that's that's kind of crystal ball.
I'm just looking at what we've got coming up that may well give us some. Oh, no worries, Jen. Thanks for the question. I'm just looking as well, Jen, at what's coming up that might drive this a little bit. We got FOMC minutes, but that's not until that's another week away. See, this is the thing, the other thing that we need to do is look what's on the horizon, which might change the picture again. Flash manufacturing, we got some. Yeah, pretty quiet for the next few weeks. I mean, you know, a potential rally in GDP not until there's quite a lot, really. Quite a lot of water is going to pass under the bridge before we get anything significant. Okay, we got the PPI numbers today, but after that, we got some quite a lot of water that could pass under the bridge, and that would suggest that if nothing else, the euro should remain robust. You know, it probably won't collapse in the next couple of weeks. From what's being suggested on the data releases, because the data, if there's no more data releases, then what the market will look for is the last one, and the last one, because it's about CPI data being a bit weaker from the United States, then the range should suggest that the euro, every time it comes down, will probably pop higher again. So you pick the right price, and you can go for a euro dollar long. I would suggest for the next couple of weeks.
Yeah, I think if you're looking to trade it short term, it's ever reliable to trade short term, and you gauge that by reversion to the mean, unless you've got a news event that makes it break out of that, aka yesterday, and also probably today. Unless you've got that situation, you can reliably have a look at your chart and go, if we're above a certain level, they'll be dictated by daily ranges, your pivots, etc. In particular, if you're above, like yesterday, if you're way above where the daily pivot lands the next day, you can pretty much count on it 70+% of the time that it's going to go back to that level. It may bounce again, it may reverse, who knows, don't know. But follow your daily pivot, and you won't be too far wrong on euro dollar, because I can tell you very, very reliably that the daily pivot is tested 70 to 80% of the time on euro versus the dollar. So what I'm saying is, if it gets too far away from that level, the daily pivot, it will generally come back to it before something else happens, whatever that is, and it may be driven by something completely different. And I think you'll find, if you want to trade that short term, just keep that in the back of your mind. So in other words, if you want to go long here, I think that would be a bad decision. Wait till it comes back, then look to trade it long. If you want to trade it short, wait till it reverses, comes back to the pivots, and do the same in reverse. You know, I don't think that will see you go too far wrong. If you just rely on those limits and look at your average true range of the day, and if it's gone outside that level, without news, I mean, on your general day-to-day basis, if you've gone outside of that range, then look for it to come back, because many high percentages of the time it will do exactly that. Classic reversion to the mean trading strategy, if you like. If you're too far away from average, wait for it to come back to average, or trade it back to average if you have the means to do that, in terms of a system to do that.
Yeah.
So
okay,
that's the short-term approach anyway.
I think that's good. Well, we are closing into the top of the hour, and I think it's been a good hour too. I think it looks like the market's on a bit of a pause, but generally speaking, things will probably resume today. I think some more selling in the dollar on the short term. You know, if the dollar sort of like rallies at all today, a little bit, you know, on an hour by hour basis, that the rallies will probably be sold off. It looks like the dollar's going to be a little bit weak for the period. And it looks like stocks will probably continue their moves to the upside, but got to be careful. I do think that those areas of resistance may end up holding. And strange, really, when we get the news that we've had to say that, but things do get priced in quite early on, and the move may well have been sort of like fairly close. Another 2% on the S&P looks around about on to me, but after that, I'm not so sure. But let's wrap it up for the week. Thanks so much, guys, and for joining us. And thank you, Jen, for the question. Really appreciate the involvement. Thank you to you, mate. Thank you to Marlon for looking after us too. and have a good weekend, buddy. I guess we'll be back next Monday, right?
We will, mate, with bells and whistles on, I'm sure. Thank you for being our trading buddies, everyone. And as Ash said, have a wonderful weekend. Look at those inflection points that we're at, and kind of wait until they tell you what's going to happen, because they will. Eventually, they will. Have a great weekend. Bye bye.